In the gray, industrial sprawl of Bayonne, New Jersey, there stood a farm of storage tanks that held the supposed wealth of an empire. To the casual observer, they were merely steel containers filled with vegetable oil, the mundane lubricant of the American food industry. But to the 51 banks and trading houses that held the receipts, these tanks were vaults of liquid gold. They believed the contents were worth over $150 million, a fortune in 1963 that rivaled the reserves of sovereign nations. In reality, the tanks were filled with seawater, topped with a polite, floating lie. It was a heist executed not with a gun, but with a dipstick, a trick of physics that would bring the aristocracy of Wall Street to its knees. Now, let us open the archives and dissect the anatomy of this failure. To understand the swindle, we must first understand the swindler. Anthony Tino Angelis was not a product of the Ivy League, nor a denizen of the polished boardrooms of Manhattan. He was a butcher from the Bronx. Short, rotund, and sweating with the nervous energy of a man perpetually overextended, Tino understood something fundamental about the banking establishment. They did not respect the commodity, they respected the paperwork. In the post-war boom, the United States was awash in soybean oil. Through the Food for Peace program, and the government was desperate to export this surplus to Europe and Pakistan. Tino positioned his company, the Allied Crude Vegetable Oil Refining Company, as the primary conduit for this flow. He bought cheap, refined specifically for export, and promised volume. But the margins in vegetable oil are razor thin, measured in fractions of a penny. To make real money, Tino needed leverage. He needed to borrow against his inventory. This is where the architecture of finance became the architecture of the fraud. In the world of commodities, physical goods are cumbersome. A banker does not want to inspect a tank of oil. He wants a piece of paper that certifies the oil exists. This paper is called a warehouse receipt. It is a negotiable instrument, treated as cash by lenders. If a reputable entity vouches that the oil is in the tank, the bank will lend millions against the receipt without ever setting foot in New Jersey. Enter American Express. Known today for its credit cards, in the early 1960s, American Express was a trusted name in logistics and field warehousing. They established a subsidiary, American Express Field Warehousing, specifically to manage Tino's inventory. It was a symbiotic relationship built on a foundation of sand. Amex craved the warehousing fees. Tino craved the Amex seal of approval. By placing the American Express stamp on his warehouse receipts, Tino effectively transmuted his gritty Bayonne operation into a blue-chip investment. The bank saw the name on the letterhead and stopped asking questions. They mistook the reputation of the custodian for the solvency of the client. With this mechanism in place, Tino began his alchemy. He would purchase a small amount of oil, pump it into a massive tank, and then fill the rest with water. Because oil is lighter than water, the oil would float to the top. When inspectors from American Express arrived to check the inventory, they would climb the catwalks, lower a sampling tube, and pull up pure soybean oil. They measured the height of the liquid, calculated the volume, and issued the receipts. Tino took these receipts certifying millions of pounds of phantom oil and walked them into the offices of Ira Haupt & Co., Williston & Bean, and the Bank of America. They handed him cash. He used that cash not to pay off debts, but to buy futures contracts on soybean oil, driving the price up, which increased the value of his fake inventory, allowing him to borrow even more. It was a perfect, self-reinforcing loop of speculation. By late 1963, Tino de Angelis had issued receipts for more salad oil than the Department of Agriculture reported existed in the entire United States. The math was impossible, a glaring paradox visible to anyone who bothered to look at the ledger of the total market. But no one looked at the market. They only looked at the profits. But a lie of this magnitude requires maintenance. It is not a static object. It is a living, breathing beast that must be fed constantly. As Tino's ambitions grew, so did the complexity of his labyrinth. The archives reveal that the tank farm in Bayonne was not merely a storage facility. It was a stage set designed by a mad engineer. Tino had constructed a vascular system of fraud beneath the soil of New Jersey. An intricate network of hidden pipes connected the tanks, allowing his crew to pump the same layer of legitimate soybean oil from one container to another, keeping just one step ahead of the inspectors. If American Express scheduled an audit of Tank 105 at noon, the oil was pumped there at 11. By 1 o'clock, that same oil was flowing underground to Tank 108, ready for its next performance. Even more audacious were the structural modifications. Inside some of the massive storage tanks, Tino welded tall, narrow metal cylinders directly under the inspection hatch. He would fill this thin cylinder with pure salad oil, while the remaining 99% of the tank outside the cylinder was filled with seawater. When the inspector dropped his plumb line, it went straight into the cylinder, returning coated in oil, registering a full tank. It was a magic trick performed on an industrial scale, relying entirely on the assumption that the auditor would never deviate from his routine, that he would never check the perimeter, that he would never doubt the integrity of the vessel itself. Tino bet on the complacency of the institution. He knew that American Express field warehousing was staffed not by forensic investigators, but by low-paid custodians who were easily charmed. Tino treated them to lavish lunches, befriended them, and slowly, imperceptibly, compromised them. He didn't necessarily need to bribe them all. He just needed them to feel that checking the tanks too rigorously was an insult to their friend, Tino. He weaponized social grace against corporate due diligence. However, the architecture of a Ponzi scheme is fundamentally fragile. It relies on the market moving in one direction, up. Tino was heavily leveraged in the futures market, betting that the price of vegetable oil would skyrocket due to anticipated demand from the Soviet Union and Spain. He needed the price to rise to cover the interest on the millions he had borrowed against the water in his tanks. Then, history intervened with brutal unpredictability. On the 22nd of November 1963, shots rang out in Dallas. President John F. Kennedy was assassinated. The psychological impact on the nation was profound. The impact on the markets was catastrophic. The chaotic uncertainty caused commodity prices to crash. The futures market for soybean oil plummeted. In the span of minutes, the value of Tino's legitimate holdings evaporated. The brokers who had lent him money, firms like Ira Haupt & Co. and Williston and Bean, issued immediate margin calls. They demanded cash to cover the drop in value. They needed millions, and they needed it immediately. Tino de Angelis, the man who had bought the allegiance of Bayonne, had nothing left. The cash was gone, siphoned off into failed speculations and personal accounts. The food for peace contracts he had promised were stalled. On Monday, the 18th of November 1963, just days before the assassination had sealed the market's fate, Allied Crude Vegetable Oil Refining Company filed for bankruptcy. The filing was the first crack in the dam. The second was the panic of the creditors. As news of the bankruptcy spread, the 51 banks holding the warehouse receipts descended on Bayonne. They were not there to foreclose. They were there to claim their collateral. They arrived with tanker trucks, ready to pump out the millions of pounds of oil they owned on paper. American Express, realizing its reputation was on the line, sent in a new team of independent surveyors to verify the assets. This time, there were no friendly lunches. There was no choreographed movement of oil. The scene described in the legal aftermath is one of grim, atmospheric revelation. It was a cold, rainy November on the waterfront. The surveyors climbed the tanks, but this time, they didn't just drop a line. They opened the release valves at the bottom of the tanks. When a valve is opened on a tank of vegetable oil, a thick, golden, viscous liquid should ooze out. Instead, what burst forth onto the boots of the inspectors was clear, cold seawater. Panic turned into frenzy. They moved from tank to tank. Water, water, sludge, water. In a desperate bid to find the assets, they began sounding the tanks, hitting the sides with hammers. A full tank of oil makes a dull thud. These tanks rang with a hollow, metallic echo that resonated across the yard. The Potemkin village of Bayonne was dismantling itself in real time. The physics of the Deceit were laid bare. The specific gravity readings, which had been falsified or misread for years, were finally corrected. As the water was drained, the sheer scale of the emptiness became apparent. Tino had issued receipts for nearly 2 billion pounds of oil. The tanks contained less than 100 million. One of the most respected brokerage firms on Wall Street, Ira Haupt & Co., was suddenly insolvent, holding millions in worthless paper. The New York Stock Exchange faced a liquidity crisis that threatened to freeze the entire financial system. The inspectors found something else, two evidence of the physical absurdity of the lie. They found tanks that were supposedly full of oil, yet were not even connected to any piping system. They found tanks that had holes in the roofs where rain had entered. They found a complex system of deception that had only worked because the victims, the banks, and American Express had been blinded by the glare of the potential profits. They had seen the receipts, and in their greed, they had ceased to see the reality. The shockwave radiating from Bayonne did not stop at the water's edge. It slammed into Wall Street with the force of a tidal wave. Ira Haupt & Co., a firm with a 40-year pedigree, was obliterated overnight. Its capital completely wiped out by the margin calls on Tino's phantom oil. For the first time, the New York Stock Exchange was forced to intervene, putting together a bailout fund to prevent a domino effect that could have toppled the entire market. But the true casualty was the currency of trust itself. American Express found itself in the crucible. Technically, the fraud had been perpetrated against a subsidiary, a limited liability entity designed to firewall the parent company from exactly this kind of disaster. The lawyers argued that the main American Express company had no legal obligation to cover the losses. But the board of directors understood a darker truth about the psychology of money. If the name American Express ceased to mean guaranteed, their traveler's check business, the golden goose built entirely on consumer confidence, would evaporate. They faced a stark, existential choice: hide behind the legal shield and watch their reputation rot, or accept the liability and pay a $60 million ransom to save their soul. They chose to pay. It was a humiliating amputation of capital, but it saved the patient. Yet, in this landscape of ruin, one man saw opportunity. While the stock price of American Express collapsed, cut in half by the panic, a young investor from Omaha named Warren Buffett began quietly buying shares. While the rest of Wall Street looked at the empty tanks in New Jersey, Buffett looked at the restaurants and hotels where people were still paying with the green card. He realized that Tino de Angelis had swindled the bankers, but he hadn't damaged the franchise. Buffett invested $20 million, nearly 40% of his partnership's assets, into the bleeding company. It was a masterclass in separating the noise of the scandal from the signal of value. Tino's fraud inadvertently laid the foundation for one of the greatest fortunes in history. As for Tino de Angelis, the architect of the mirage, the courts were less interested in his genius than his arithmetic. He pleaded guilty to fraud and conspiracy. The man who had moved global markets and humiliated the titans of finance was sentenced to 7 years in federal prison. It was a pedestrian end to a spectacular crime. When he emerged, he tried again. Fraud was in his blood, a compulsion he could not shake, but the magic was gone. He died in obscurity, a ghost haunting the margins of the industry he once briefly ruled. The great Salad Oil Swindle remains a singular case study in the archives of financial crime. It proved that due diligence is often nothing more than theater. The bankers saw what they wanted to see. The inspectors checked what they were told to check. The system failed because it was built on the assumption of honesty, yet it incentivized the practice of deceit. The tanks in Bayonne are long gone, replaced by new infrastructure, new industries, and new schemes. But the lesson remains etched in the bedrock of Wall Street. Wealth is not defined by what is on the receipt, nor by the stamp of approval from a prestigious firm. Wealth is only what remains when you open the valve and watch what flows out. In the end, gravity is the only auditor that cannot be bribed. It is a reminder that in the pursuit of empire, we often build our castles on foundations of water, forgetting that the tide always, eventually, goes out.